Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is market risk considerations under the US Basel Endgame proposal. My name is Jeff Taft, and I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement practice based in the DC office. Joining me today is my partner, Matt Bisanz. Matt is a partner in Mayor Brown's Financial Services Regulatory Group and also with me in the DC office. With that said, let's begin. I thought it would be helpful to start off with a brief discussion of what is market risk. Market risk basically consists of general and specific market risks. General market risk is a risk of loss that results from broad market movements, for example, movements in interest rates, equity prices, foreign exchange, or commodity prices. Specific risk is the risk of loss on a position that could result from factors other than broad market movements. This would include events and default risk, as well as certain other idiosyncratic risks. With that quick background, let me kind of start us off today in talking about the applicability of the market risk capital rules. And then Matt will give us some discussion around some of the key policy and other issues that we're coming across. So currently the market risk capital rules only apply to those banking organizations whose trading activities exceed a certain threshold. The trading activities threshold is 1 billion of trading assets plus trading liabilities, or 10% of the organization's trading assets and liabilities. This trading activity threshold is based upon an end of the quarter amount and in the regulatory reports. This currently covers about 40 or so banking organizations. The proposed rule will have much a broader application. It will apply to all category 1 through 4 banks. Those are all the banks with over $100 billion in assets, regardless of their trading activity. And any subs of such organizations if those entities engage in trading activities over the last 4 quarters. It also applies to any organization who exceeds the trading threshold. The trading threshold is very similar to the prior one, except it's bumping up from 1 billion to 5 billion of trading assets plus trading liabilities, or 10% of the total consolidated assets of the institution or trading assets and trading liabilities. Obviously, this will have a group of new organizations and institutions will be subject to the rule who were not previously subject to it. In addition to complying with the requirements of the market capital rule, they'll also have to undergo some systems and other changes basically to deal with the operational issue of tracking market risk and market risk exposures. This obviously could have significant impacts on those institutions, even those who don't have significant trading activities, based upon the need to at least get those systems in place. With that kind of brief overview of the applicability, let me turn it over to Matt, and maybe he'll start us off talking about some of the market risk positions and the changes in the proposal.
Sure, thank you, Jeff. Historically, the number of or the types of assets that were subject to the market risk capital rule was limited in scope, and it included things that were traditionally trading assets and liabilities that were held for a short-term trading purpose, or certain other types of obviously trading things like certain commodity positions, foreign exchange positions, things where you can say a bank doesn't have exposure to credit risk. And there was always something of a question around how to handle investments in equities and other types of securities where the bank wasn't holding it with a trading intent. And I think that many of those positions that were not publicly traded moved over into the credit risk book. Some public equities may have moved over into the market risk book, but the boundary wasn't well defined. The proposal would define the boundary between market and credit risk in considerably greater detail. Some of the detail matters, some doesn't. For example, in the short-term intent prong, or the trading part of it, it would include trading positions that are held for the purpose of regular dealing or making a market. And that may sound like a big change, but when you think about what currently is in the rule of trading positions held with a short-term intent, that's almost a perfect coverage for a Venn diagram of dealing or making a market. So that addition isn't or shouldn't be all that substantial. But other additions to the definition of a market risk capital position, such as net shorts, or where you have net short positions of 20 million or more, that's where you have maybe, say, a hedge on an underlying exposure, and the hedge is overhedged or anticipatorily hedged, and you haven't yet taken on the underlying exposure. That net short position ends up in the market risk capital book. Certain types of embedded derivatives that are bifurcated for accounting purposes, those are now going to be in the market risk capital book. A wider range of non-public equity investments, so investments in investment funds, where the bank has access to the prospectus or otherwise can look through to understand the fund's underlying exposures, those will now be subject to market risk on the theory that the bank should be able to look through and get readily discernible market prices. And then a wide range of internal risk transfers and credit valuation adjustments will be included in the market risk. And with the internal risk transfers, the idea here is, as we'll get into in a minute, there's going to be a lot more tracking of internal risk transfers to prevent gaming of the banking versus trading book boundaries, and so the including certain types of internal risk transfers will pick that up. And then the CVA hedges is there's a much greater focus on derivatives exposure, quantifying it, and doing it in a more sophisticated manner. And so those will now be included in greater detail. But yeah, Jeff, so I think a lot of work here for the accountants in deciding this boundary.
I guess maybe talk a little bit now about the trading desk approach, which they've kind of used, which, isn't all that unusual a concept, but I think it's kind of generated a lot of questions based upon the proposal.
Yeah. So when you look at the Basel standards, which aren't laid out like US regulations, they actually have like big chapters. They don't have the subsections that we're used to seeing in US regulations. There's this entire new concept of a trading desk. And a trading desk is a unit of a bank that has its own effectively P&L. And it engages in trading activities. And for those who are familiar from the Volcker rule concept, it's similar to that. And so going forward, the market risk capital rule says a bank must define all of its trading desks for all of its market risk capital positions. And this is somewhat broader than the Volcker rule, because the Volcker rule says you only need to do it for certain types of exemptions. So if you're using, say, the underwriting exemption or the market making exemption, then you have to map that at the trading desk level. But for other things like TOTUS or the government securities exemption, the Volcker rule isn't that concerned with trading desk. But you clearly could have some of those kinds of positions that end up in the trading book, and so all desks that have market risk capital positions have to be mapped to have to be subject to the governance requirements. They also would need to be subject to specific types of modeling requirements. And this is where things get interesting, that the Basel Committee and the US standards go through all of this of what is a trading desk, how to map it out. And then when you get into the math to figure out the capital requirements for a position, there's almost no mention of trading desks. There's a mention of, well, if you are a trading desk that is authorized to use internal models to calculate your capital requirements, here's the criteria you must meet. Here's the backstops. Here's how you relate to trading desks who don't use models. But there really isn't much around how do you take the numbers from each trading desk and move them up into either your internal models or the standardized formula. And I think probably the intent was to allow it to be done at an aggregate level, certainly to recognize some benefits of netting and offsetting among desks. But this dichotomy in the proposal is rather striking, that there isn't a connection, particularly for banks who won't be using internal models, who elect not to use internal models, on what the trading desk means for them.
I guess let's kind of move from that, maybe start talking a little bit about kind of the standardized measure and how the backstops would apply and kind of the supervisory discretion that could be in play there.
Sure. So the math is obviously beyond me. That the math here is really elegant math. But the ideas for market risk, like Jeff was saying, it's the summation of all of the types of general and specific risk that come from a position. And there will be a number of formulas that banks must calculate for their market risk positions, including some that are backstop. So there's things like a fallback capital requirement to account for certain risks posed by using an internal models approach. If there is a redesignation of an exposure, say from the banking book to the trading book, or vice versa, and that would create a capital benefit, there's an add-on for that type of redesignation to prevent gaming. And then there's also the ability of a bank's primary regulator to add on their own capital requirement to market risk. This is like a Pillar 2 type supervisory requirement that again just adds on a bit of additional calculation beyond what would be an expected shortfall or other type of market risk capital requirement. And I think some of this will catch banks by surprise if they're coming from the historical credit risk regime, where an exposure generally had one, maybe two formulas to it, and now you're having, say, 5 formulas, including some that are punitive conservative factors feeding into the capital calculation.
Maybe switching now, talking a little bit about kind of the default risk capital calculation and how the US's proposal, I guess, differs a little bit from Basel in the fact that you can, under Basel, you could use the internal approach, but here we're using a standardized approach.
Yeah, so one of the themes of the US the entire time I've been practicing as a lawyer is that regulators don't trust models. And it's interesting that in that same time, regulators have adopted capital stress testing, which is based on models, as their own favorite thing to use to supervise banks. But when it's banks doing the modeling, the regulators don't trust them. And this has made its way over to the market risk rule, because one of those formulas that I was just talking about that will feed into the capital calculation is the default risk calculation, or the capital at risk from potential defaults. And this is interesting, as Jeff says, under Basel, you can use an internal model to calculate the capital requirement for default risk. Under the US proposal, you would not be able to use models to calculate it. There would be a standardized formula that all banks would have to use, even if they otherwise were using internal models to calculate their other risk factors, that they could not use it to calculate their default risk capital requirement. And this, I think, will again be somewhat punitive, because traditionally a standardized formula is going to result in a higher capital charge than an internal models formula, because the standardized formula does not reflect the full information about an exposure that a bank has.
I guess kind of in a similar vein, obviously there's a floor now that's basically kind of being imposed in connection with the market risk capital requirements. Maybe talk about the floor, and I think we've seen this in other situations too, how it will have an impact on the calculation.
So one of those things that Jeff and I always are confronting is how to write things for clients. And the regulators love to start off sentences with things like, well, take the greater of X, Y, and Z, or take the lesser of the greater of X, Y, and Z. And that's just frustrating because you kind of say like, well, why couldn't you pick X or Y as the constraint? Why do you have to impose these ceilings and floors on regulation? And really for banks, it's a huge burden because the banks end up having to calculate both X and Y every time and take the greater of them. And that is true even more so under the capital proposal, particularly in the area of market risk. And the floor that Jeff is referring to is in banks' use of models, that when they are calculating their capital charge, and if they are authorized to use models, first they have to take their capital requirement for the model desks, give an add-on for profit and loss, add it to the standardized capital requirement for all their non-model desks, and then compare that with the standardized approach as if everything was subject to the standardized approach, and take the lesser of the two. And so this effectively creates a floor, or I guess a ceiling more so, that a bank's modeled requirement cannot exceed the standardized approach. You say, oh, that's great, but then you have to add in all of those fallback requirements that we were just talking about, and then you end up with another position saying, well, is my internally modeled capital requirement less than 72% of my overall capital requirement? And if it's less than 72%, then I actually have to use the standardized approach, not the internally modeled approach. And so what was a ceiling has now become a floor when I move to the next step of the calculation. And again, that's just one of those things that for a lawyer trying to write it, it's annoying. For a quant trying to write a computer program, it's probably a little less annoying because they actually know how to use logic in ways that lawyers don't. But then for the business person trying to price the risk of a trade or price the hurdle rate for their book, it's even more frustrating.
Thanks. I think it's a good point. I mean, I think we see this a lot, and the double calculations and going back and forth over time, switching from one to the other or the like, can be frustrating. You know, there's one aspect of this that's kind of outside of the proposal itself, but it has an impact on others who aren't banks, believe it or not. I guess the CFTC, has allowed certain swap dealers to elect to basically use the bank-based capital requirements, the market risk capital requirements, to calculate their calculate their capital if they want to. And obviously we think there are some folks who have done that. I guess it'd be kind of interesting to think about how some of these changes may ripple through to these swap dealers.
Yeah, when I was back in law school, I worked for this little government agency that no one had ever heard of, and probably no one has heard of, the Administrative Conference of the United States. And their goal is to make rulemakings better. And one of the topics they were looking at when I worked there was this idea of incorporation by reference, and all of the pitfalls when an agency says, look, I'm just going to incorporate something by reference instead of making my own rule. And at the time, the big thing was, well, what if I incorporate some private standard that is subject to copyright, and the person holding the copyright charges people thousands of dollars to access it? Should people have to pay a fee to find out what the law is just because an agency decided to incorporate it by reference? And that was the whole thing at the time. But since then, I've had an awareness that there are all sorts of pitfalls by incorporating by reference. And you're right. One of these comes up in the CFTC's capital rules, that back when the CFTC, it's only been a few years, made capital rules for swap dealers, it was faced with a number of different business models. That there are obviously some swap dealers that are banks, and so they aren't even subject to the CFTC's rules. They're just subject to the bank capital rules. There are some swap dealers who are your traditional agro businesses. They have wheat fields out in the Midwest. They have silos in Minnesota. They're the actual grain producers, and they have relatively simple balance sheets, and they don't have the quantitative staff that even a broker dealer has. And then you have things in between, like the futures commission merchant that's affiliated with a bank, or even a standalone futures commission merchant that looks like your traditional broker dealer, but just in futures. And so the regulator said, well, look, we can allow them to use capital requirements like we already have in the futures industry for these types of swaps, or we can let swap dealers elect to use bank-based capital approaches. Now, maybe it was a good idea, maybe it was a bad idea. I won't go there, as I'm sure our clients have differing views on it. But the CFTC said, when we mean bank-based, we mean the Federal Reserve's capital requirements, and in the CFTC's regulations include several explicit references to, well, if you're going to use internal models for market risk, this is the chapter of the Fed's thing that you use. If you're not going to use internal models for market risk, here's the chapter of the CFTC that you use. If you're going to use internal models for credit risk, here's the Fed's definition of capital, where it's located. And so the CFTC effectively incorporated by reference a wide set of the Fed's capital rules. This is now becoming a problem because under the Fed's proposal, some of those references now will either be incongruous, so that they will result in an unexpected outcome, like one of which being the Fed is moving away from internal models. And so one of the CFTC's cross-references for internal modeling of credit risk no longer makes sense, because the Fed just isn't going to provide that option. That's one level of incongruity. Other parts of it are where there is a change to the underlying formula. So, for example, the Fed made a modest definition to the calculation of counterparty credit risk. I don't think it's particularly material in the market, but the way in which credit risk-weighted assets are calculated depends on counterparty credit risk. And so this handful of changes, like the shift in a certain parameter of a Greek letter that I don't know because I wasn't in a fraternity, that's going to change the option to decompose a nonlinear index into single name derivatives. So if you have an index of say 15 reference exposures, you could break them down into single name CDS to track them in a more granular way. That option is going to disappear for nonlinear indexes, because it turns out you can't mathematically decompose those. And so that kind of change that the Fed is making will feed through to the swap dealers. And so on one hand, they'll have to update their systems for it. But on the other hand, it also changes the math that the CFTC based its calculations on. That the CFTC said, for example, that swap dealers have to have 8% capital under the Fed's standards. And they said this is what we feel is sufficient. Yes, it's greater maybe than it might be under some of our other ideas of capital, but this is what we need. And so now if the Fed is changing its formulas, maybe generally increasing the capital requirements for things like market risk, that will feed through to the CFTC in a way they didn't expect. The bigger problem, Jeff, and I apologize for monopolizing the time here, is that the CFTC is in no hurry to act on these things. It has a huge plate with carbon offsets, with Bitcoin, with its own rulemakings around fraud and manipulation. And it has no interest in reopening the capital standards. And I think the swap dealers have no interest in seeking new validation and approval for their models. And so the question is, what do you do? Do you just leave things as they are with the current Fed rules and kind of ignore the incorporation by reference? Do you expect swap dealers to change over to some other approach that isn't affected by this break in regulations? I don't know. What do you think?
It's an interesting one, because it's almost as if you've opted into this, it's almost like you've agreed to basically taxation without representation, because now you have really no say on the standard, how it's changing. I guess you could always, comment or do other things about it, but really you're kind of along for the ride at this point. And when you get to the end of the ride, you may decide you want to have a different vehicle for the next ride, and you may end up going back and having to do everything again operationally, getting new models and things like that. So it's a challenging one. Anytime you incorporate by reference, as you say, it's always an administrative nightmare. It never works out the way it does. People repeal things, they get rid of things, and then next thing you know, the law doesn't make any sense when you go to look at it.
Exactly.
So maybe going back to something we touched on earlier, just to kind of bring back this kind of two approaches, but we have the dual stack approach. I think that has an impact in a lot of different areas, but obviously it has some potential impact, in the market risk rules as well.
Yeah. So this one was interesting that it was actually Jonathan McKiernan who brought this to my attention when he came to our offices a few weeks ago to speak, as he talked about this idea that banks will be expected to calculate their capital requirements under the current credit risk rules and the new market risk rules, and then the new credit risk, market risk, operational rules, and take whichever is more punitive. And he pointed out that there could be shifting back and forth between these columns depending on just how banks' exposures change over time, how values change over time. And that applies really the same in the market risk context, because as I talked about, there's that 72% floor below which a bank can't use its internal models to reduce its market risk exposure. And that floor also would result in the same shifting, that you might have times when the models show that credit risk is quite low, and so it pushes below that 72% floor. And so then you're flipping back to the standardized approach, or maybe the 72% floor. And so a bank, again, has to keep monitoring its exposures under each stack and shifting back and forth on an ever-changing basis. And for accountants, that's what they live by, but for the trading desk trying to price the carrying value, generate its internal P&L to show why it should stay employed, it really makes it a moving target when you have different stacks that you're measuring against.
Certainly interesting, and certainly a lot of vexing questions. I think, a lot of folks were quick to focus on credit risk. Operational risk has seemed to get a lot of play in the press, but I think market risk is one of those oftentimes overlooked things. It's, as you say, it's got a lot of technical math, and it's maybe people are shying away from it, but it's certainly going to have an impact on the organizations that are subject to it, and there's a lot more who are subject to it. So I think it's something that people are going to have to start to figure out, price in, and see kind of where it leaves them. I think with that, we've probably kind of come to the end of the time we had, so maybe want to kind of wrap it up here, I guess.
Yeah, thank you, Jeff. Yeah, I appreciate that, and I appreciate our listeners for dialing in. I know this is one of our denser calls on the series of Basel Endgame reforms, that with the extended comment period, maybe people will dig deeper into this. I think our draft comment letter is only up to around 40 pages or so. I know some of them are getting close to triple digits. And so, but if you do have questions about this topic, please feel free to email Jeff or myself, or the email for GFMs, which is gfm@mayorbrown.com. With that, we've concluded this podcast. Thank you and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.